Investing in the real assets that underpin our digital world has never been easier. We are pleased to bring you this podcast in partnership with Roundhill Investments, the advisor to the Roundhill IO Digital Infrastructure ETF, BYTE, which trades on the New York Stock Exchange under the ticker symbol BYTE. The fund tracks the BYTE Index, which measures the performance of 40 leading global digital infrastructure businesses, such as towers and mobile communications, fiber and fixed line connectivity, and data centers. For prospectus and more information, please visit roundhillinvestments.com/ETF/BYTE. Please read carefully. Investing involves risk, including possible loss of principal. Investors should consider the investment objectives, risks, charges, and expenses carefully before investing in BYTE. Distributor Foreside Fund Services, LLC. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow, rate, subscribe, review it wherever you're watching or listening to it. With me today, I'm happy to have Chadd Garcia. Chadd is a portfolio manager at the Ave Maria Focus Fund. Chadd, how's it going?
It's going great. How are you doing today?
I'm doing great. We had some tough technical difficulties getting this up, but that's behind us now, and I'm excited to get the podcast going. Let's start this. Go ahead.
At least we're not talking about bank stocks.
Oh my God, that Silicon Valley Bank. I can't even talk about it right now. Let me start this podcast the way I do every podcast with a quick. You know what? I can. No, disclaimer first. A quick disclaimer. First, the disclaimer to remind everyone: look, nothing on this podcast is investing advice. We're not financial advisors. Everyone should consult a financial advisor. Please do your own work. We're talking about a stock that Chadd has done a lot of work on, obviously deep diligence, but I believe he's got a holding in it. I don't have a position in it, just to give that disclaimer, but everybody should keep that in mind. I'll just go back to the banks you were talking about. I have a tweet out there from a few weeks ago where somebody was talking about negative equity banks, and I was like, there's only a couple out there, and the one that comes to mind is Silicon Valley Bank, and I kind of looked at that and I was like, oh, it's trading at 1.5 times book, and just didn't really do anything, and now the stock is... We're talking on Friday, what is it, March 10th, and it looks like they are in serious trouble. And I'm just like, how do you miss that? How do you miss that? But anyway, neither here nor there. The stock we're going to talk about today is DigitalBridge. The ticker is DBRG. This is a stock with a long history, very complicated financials that I think they're going to simplify in 2023. That could be an interesting thing. But I've rambled about both DBRG and other stuff. I'll just turn it over to you. And what's so interesting about DigitalBridge?
Well, as you said, the stock has a long history, and there's a history of the company going back, prior to its public entity, which is, now DigitalBridge, but formerly Colony Capital. And if you go back in its history, Marc Ganzi is the CEO. He founded a tower business. At one point, he got backed by Blackstone as a financial sponsor. They drew it and they sold it for several billions of dollars to American Tower. The partner that backed Mark at Blackstone was Ben Jenkins. He was a senior managing director there. I believe he ran telecom and as well as the Hong Kong office at one point. He ended up leaving Blackstone. Him and Mark formed an entity where they were doing deals in the digital infrastructure space. Think towers and data centers and small cells and dark fiber. And they were doing it with their own checkbook, doing fundless sponsor, a lot of their own capital put into it as well. And they had some initial successes. And if you're successful in this business, you're going to attract competitors. Other infrastructure investors and large PE firms wanted in on it. And I mean, even to this day, if you listen to KKR or Blackstone's or Brookfield's earnings calls, they talk about a heavy focus in digital infrastructure. And so this is, as of now, the place to be as far as allocating private capital to. But when the other firms entered, Mark and Ben, knew that the days of doing it as a fundless sponsor were over, that you needed to be able to underwrite and write a check quickly. And at that point, they looked for ways to set up proper funds. And I believe Mark's father knew the CEO at Colony Capital. That organization was going through some problems. They had a couple things. They had a public shell, and they had a balance sheet, and they had relationships with allocators. And so Colony Capital bought Marc and Ben's entity, which was called DigitalBridge. They renamed Colony Capital DigitalBridge. Marc was set up as the CEO in waiting, and Barrick at Colony introduced Marc to several of the allocators, particularly in the Middle East. Go forward, Barrick left Colony Capital. Marc and his team sold off all the legacy assets, or at this point, most of the legacy assets of Colony Capital. They did so without hiring bankers, which I think gives some indication of their ability and the culture as far as watching expenses, et cetera. And now they're at a point where they are almost a pure play investment management firm or alternative investment management firm. There are a handful of investments, two major ones that are left on the balance sheet that makes their financials a little bit complicated, but that should be cleaned up this year. And it's going to be much easier for investors to look at the business and analyze what's going on, once the financials are simplified. And when you look at alternative asset management, I've been involved as an investor in Brookfield and for several years, and then KKR, right when they switched from an LP to a C corp, I was involved in that for several years.
You're speaking my language with both of those. Yep.
And what's interesting about DigitalBridge and even Brookfield is that their funds are very long life. So let's say you have an average life of 5+ years for a PE fund. Well, the infrastructure funds are going to be, average life probably 11 years. And so you can see what the fee revenue is going to be for a long time. And after that, it's raising additional funds. Each new fund they raise, brings in incremental fee revenue with not that much more incremental expenses. And so from a predictability and a durability of their cash flow streams, it gets pretty easy to analyze. We're not there yet because they have some of the legacy assets that they're getting rid of. So, DigitalBridge has got compounder potential, but it's trading at an egregious valuation because of the complications with respect to the current financials, which should be done, should be over with soon. And if you want to, it's tough to get a great business that's going to compound its earnings for a long time and pay a cheap price. And so if you want to pick one up, you want to do it, when there's some dislocation or some confusion as to the financials. And I think this is a good case study in that.
That's perfect. That's a great overview. And I want to dive into a lot of those points. I want to talk valuation. I want to talk about some of the stuff, but I do think I know several people who are invested in DigitalBridge. I know people who really kind of smashed it out of the park with, as you mentioned, a lot of people historically got burnt by Colony in one way, shape, or form or another. And I know a lot of people who made a lot buying DigitalBridge once kind of the old CEO was gone and Marc took over. This was going to be new DigitalBridge, go forward. And they made a lot of money, saying a lot of people just won't even look at this. And I do still think, just as you said, because of all the complications, I think there's still that hair on it, which will go away. But a lot of the people here, they're here because of the cheapness. They're here because of the sum of the parts. They're here because of compounder story. But I think a lot of it does come back to Marc Ganzi. A big piece of this is a bet on the jockey type style. I've really liked how he talks about the business, just having probably read the past 3 conference calls and they go to a lot of conferences as well. So read a lot of those. But do you want to talk about Marc Ganzi a little bit more and how you kind of view him as a bet the jockey type setup?
I think this is part bet the jockey, but more it's bet the horse as opposed to bet the jockey. Ganzi is impressive. Some people say that he's an excellent salesman and can sell ice cube to Eskimos.
I can see, having read the transcript, I can absolutely see this man, every deal you're like, I want to back this guy. This sounds awesome.
But let me just challenge that, because when I think of salespeople, I think of people that appeal to your emotions. And I don't think he's a salesman as he is a general manager that knows a lot about his business and a good marketer. He knows his business inside and out, which is evident on the calls, and which in part what gets me excited about it. But he just tells you, like, here's what we're going to do, and here's how it's going to work, and here's where our financials are at, and here's our negatives with respect to the complications of the financials, and here's how we're going to clean it up, and here's the timeline, and if you want in, you want in. If you don't, you don't. So I don't think he's salesy as with respect to appealing to somebody's emotions to try to get somebody in, as opposed to just laying out the facts of the business as he sees it, and either you agree with them or you don't. But finance people are pretty hardworking, and I know some other shareholders that know him personally, and they say that he's the hardest working person that they know. He misses a lot of, as they do go to a lot of events, but there were several investor events this week that he was supposed to show up to, and he ended up sending the CFO to him because he's over in the Middle East. Last year at the Formula One race in Miami, they sponsored a booth and had their clients there. I know some people that were in their booth with them, and he left the race early to get on a plane, which is his own plane, to fly over to the Middle East to raise capital. Now, one would think if it's your own plane and you can control your schedule a little bit, you might wait till the end of the race, but he didn't. So I like that.
I like that too. The man's fundraising. Look, if you're running a digital infrastructure fund or any type of alternative asset, Middle East is the place to go. Okay, so
but back to it real quick on if you look at the people that he's attracted into the business, it's impressive. I mean, from an internal investment team standpoint, as well as the CEOs of their portfolio companies. A lot of the CEOs of the portfolio companies, like one of them was the CEO of Equinix. So this guy doesn't need to work, and they're running sale for him. So there is something special that attracts top players to this organization, but there's a lot of talent within it. So I mean, if something happened to Ganzi, it'd be unfortunate, but I think from the investment team standpoint, it would be fine. There's more talent there.
Perfect. So why don't we start by just look, you and I are talking, the stock is trading a hair under $12 per share. It's March 10th. Why don't we just start by, because as you said, the valuation argument is the overarching thing, and we could go talk about all the different pieces, but at $12 per share or just under, how do you see the sum of the parts for DigitalBridge? Yeah,
well, there's no real standard, I think, in analyzing alternative asset managers, but the approach that Blackstone and KKR take is using distributable earnings. And so what that is, the distributable earnings are your fee-related earnings. So that's your management fees that you're getting from raising capital. And then occasionally carry comes in, and realized returns from investments come in. So that gets added to the fee-related earnings to get you down to digital or distributable earnings. And then taxes, if there's any, and any interest or capital structure issues kind of coming out of that too. So it's almost like EPS. Now, where it differs is that an EPS number would include if you had any invested capital and you increased that in the quarter, any increases in invested capital would flow through to recognize earnings. It doesn't on distributable earnings. It's kind of more like a free cash flow proxy. So if you look at KKR and Blackstone, they're kind of pushing towards using that metric. But then if you look at Brookfield, and Brookfield has a significant amount more of corporate invested capital on their balance sheet than other asset managers. They value the invested capital separate, and then they subtract out any corporate level debt to get to like a net invested capital. And then they will put a multiple on their fee-related earnings and their carried interest, like a 25 multiple, I think they use on fee-related earnings, and a 10x on carried interest.
I think that's about right. Yep.
So that's how those two work. And so, DigitalBridge is right now is kind of stuck in a world where they have two investments that are on their balance sheet. They own 11% of one data center business called DataBank. They own 13% of another business called Vantage SDC. And because they have board seats and control these businesses, they are forced to consolidate them on their balance sheet. So if you look at the sell side analysts, they'll put multiples on these two businesses and net out the 90 or 82%, or 88% that they don't own, and try to come up with some value. But you can also just look at the balance sheet. They've had transactions in these businesses, fairly recently, and just look at the net. And so that would be the value of those. But they also have several other invested capital assets. They've got nearly $500,000, or just over $500,000 of firm's capital that's invested in the GP and their GP contributions to the funds. And so, that often just gets ignored. But if you take the Brookfield approach, you should include that. And so if you go on and look at all the invested capital in their business and then subtract out the debt, I get that to around $11.47 a share. Now that doesn't take out the value of their $800 million plus in preferred stock, but the company announced distributable earnings projections in their last earnings call. They haven't given those projections, and in those projections, they are assuming the current capital structure, which includes the preferred payments to those preferreds. And so you can just deal with it that way. This company's fee-related earnings, if they hit their multiple, should go at a 40% plus CAGR over the next couple of years, where Blackstone's not doing nearly that, and Blackstone trades at 21 times distributable earnings. Oh, by the way, Blackstone's distributable earnings, because it's a much older firm, is going to include some realizations in it and carried interest, where the DigitalBridge distributable earnings estimate isn't factoring in any returns of capital nor carried interest.
And now, a quick word from our sponsor. Comprised of 40 of the world's leading digital infrastructure businesses, the BYTE ETF, ticker BYTE, trades on the NYSE and tracks the BYTE index. BYTE looks globally for companies such as mobile tower, fiber, and data center operators. For a prospectus and more information, please visit roundhillinvestments.com/ETF/BYTE. Read carefully. Investing involves risk, including possible loss of principal. Investors should consider the investment objectives, risks, charges, and expenses carefully before investing in BYTE. Distributor Foreside Fund Services, LLC. So let me just pause you right there to do a summary. So right now we've talked about, and I fully agree with you. I was invested in KKR for a long time. I was invested in BAM for a long time. The way to value these things is to split up. You've got the balance sheet value, which consists of your investments in your operating assets, your funds, all that type of stuff. You put that on one side, and then you put some type of multiple on the income stream. I personally agree with you. The original way they did it, with you put a multiple on the fee-related earnings, and then you put a multiple on the incentive, because those two deserve different multiples. I think that's the way to go, but everybody likes to do DE now because it's simpler. So whatever, we can talk. But we've only talked about the first thing so far. And what you said is, hey, I think about $11 per share in asset value on the balance sheet exists. Now, as you said, that is before the preferreds, right? Because the preferreds,
that's also net asset value. So I exclude all the debt.
Yep. You exclude all the debt. Net asset value about $11 per share. That's before the preferreds, which the preferreds are a little over $5 per share, if I'm remembering the math in my head correctly. And you're doing that for a good reason. The company gives you DE targets that deduct the expense from the preferreds. So if you use their targets for DE and then the invested capital less the preferreds, you'd actually be double hitting them for the preferred. So $11 per share. So what you're telling me is you think that basically the company's balance sheet value right now covers almost all of the company's share price?
Right. and then, Charlie Munger always says invert, always invert. And so where am I going to get hurt in this? If you want to look at this another way, you'll get hurt if they never raise another dime of capital, or you could get hurt if they never raise another dime of capital. Let's just say, for some reason allocators, don't like what they've done in the past and, just completely shut off. Well, these funds, as we discussed, are 11-year funds. And so, I ran out what their fees would be for, call it 8 years and, did a DCF on that. And, arguably my expenses that I'm burdening that free cash flow stream would probably be high because they wouldn't need all the staff, but, be conservative. If you add that to the asset value and then take out the preferreds, that's a little over $10 in value, and they're trading at 12 today.
Perfect.
So you're almost getting this business today at runoff value.
And I just want to pause because when I was prepping for the podcast, I was emailing you, and I sent you. I try not to look at much sell side, but I was interested because I hadn't heard the asset story pitched on the sell side. So I sent you a sell side model that kind of had the value of their balance sheet about flattish. Obviously, we've talked about the preferred stuff, which does make a difference, but they were still well under you on the balance sheet side. So I just want to ask, what do you think this is a complicated story, right? We talked about how they're consolidating two businesses, but what do you think the sell side is kind of missing when they look at the asset value side of this business?
Well, I think there's two issues with the sell side, and I haven't read all the reports, but I would say on the asset value, they're probably not giving credit for the invested capital that's in the proper funds. So, DigitalBridge Partners 1 and 2. They're probably giving value to some of the legacy balance sheet assets, but kind of excluding that because I think they think they're picking it up in their value, in their multiple on the business, the multiple on the investment management business. So they're excluding, doing a true, like, what is the net invested capital in this business as Brookfield kind of lays that out, right? And then the other error that I think that they may be making is that if you look at the history of the coverage of the firm, it got picked up by a lot of telecom analysts.
Yep. And
I think so there was a big miss a couple of weeks ago when they reported a miss on the sell side's estimates for distributable earnings and what the company laid out. Now, if you dig into it, the company did not assume any carried interest. So maybe the company should have been a little bit more forthcoming about that, but they always say that they don't include carried interest in things. So if you followed it for a while, you would know that. And I think that the kind of the telecom analysts may have got tripped up a bit with respect to realized gains. They may have been treating the growth of the GP contribution to the funds as DE, when that only occurs when there's a realized gain or a sale. And so I think that was another miss on their part.
Just on what you're saying there, I was just laughing because the only sell side report I've looked at this, again, I try not to read sell side, is Deutsche Bank did an initiation on them in mid-February. That's the sum of the parts I sent you. And the Deutsche Bank thing is exactly what you say. Like, the second page is the company who covered says, hey, we're telecom analysts. We'd like to thank our asset manager analysts for their help with the insights and thinking through how to value that, which, it's fine. They're DigitalBridge. Obviously, the underlying drivers, a lot of it is going to be how telecom and digital assets perform. But it's just funny when you're covering an asset manager and you're thanking your asset management side for helping you think how to do that. So I do agree with you that there's the potential for some miss there.
Stuff will get worked out over time. Like they'll either adjust their numbers down, or DigitalBridge will footnote very in bold with bold letters excludes such and such, and that stuff gets worked out.
And look, that's an undervaluation caused by the sell side, quote unquote, like that will get worked out over time. The company will talk about share buybacks in a second. And the second thing is, it's not like analysts aren't smart. Like if they cover this company for 2 years and they're getting, inbounds from investors on how to think about this, and the company's like eventually they're going to pick up how to look at this and how to think about this.
Yeah, so I don't know if I would blame the sell side on the undervaluation exclusively. I mean, if you look, the big drop in the price happened last summer, and as like you've covered KKR, and there was a nice positive move from when they went from the LP ownership structure to the C corp because it attracted new shareholders.
Yep.
That's going to happen. That should happen here too, as people that want to be focused, that want to be allocated to investment management businesses come in. But in May, they announced that they were de-REITing because Colony Capital was a REIT for tax reasons.
Yep.
And because DigitalBridge is moving away from investing off their own balance sheet, they don't need that structure. It's not appropriate for structure for an investment management business. And so they created for sellers at a time of peak market pessimism, which was the summer of 2022.
I was absolutely, I have on my thing to talk about the transition from REIT to C corp. So we maybe talk about that in a second, but yeah, so I think we've covered the asset side well, right? So about $11 per share covered, not including the preferreds. The preferreds will deduct out when we talk about DE, but let's just go to the income side. Let's talk about how you're thinking through the income side of the statement, the ongoing cash flow, the value there.
Well, they got about 26 billion of, they call it FEEUM, fee earning equity under management. Like Brookfield calls it fee bearing capital.
Yep.
Their goal is to grow that to 8 to 10 billion this year. They've got 3 funds that will be in the market this year. They have a core fund, a credit fund, and they'll launch their 3rd flagship fund. And so, they've already done some deployments out of the core and credit funds. Some of them were raised from co-invest, some weren't. They recently announced $100 million deal for their credit fund. So, I mean, what kind of size of fund does that imply? I mean, I would probably say 2 billion on a minimum.
Off the top of my head, I'd say around that.
Yeah. So they earn on proper funds, they earn 90 bips of revenue. About 65% of that gets you to net income, or distributable earnings before carry and realizations. And then if they do co-invest, which they do often, then the funds the fees come down a bit. And allocators like that because it allows them to kind of buy down their fees on their allocations. But DigitalBridge likes it too because it allows them to kind of punch above their weight class and take down some very large deals.
Yep.
Some deals, like you saw on GD Towers, they partnered with Brookfield. They're not going to be charging money on Brookfield's capital. So there are some instances where anchor investments come in. They don't make any fees on it, but what it allows them to do is form capital around that and raise co-investment capital from other investors and earn fees on that. So, I mean, I think that they're in the hottest sector with respect to secular tailwinds, which is data and the digital infrastructure. Allocators are under allocated to both infrastructure and especially digital infrastructure. So I think that their ability to raise capital and hit their goals is real. And if that occurs, then their distributable earnings over the next few years are going to grow at a 40% plus CAGR.
So I'm just looking, this is their Q4 earnings slide. It's slide 20 for anybody who's going in diligencing this company or anything. The kind of midpoint of their distributable earnings per share is in the low 40s per share. I think I'm doing my math correctly.
Yeah, 40 and 60, it's like 40 and 60, right? Was the range for the 23?
So if I'm looking correctly, this is the guidance without, this is the updated guidance without M&A. The low end is 0.26 per share and the high end is 0.6. And that's for 2023. And then for 2025, this is on DE again. The low end is 0.75 and the high end is just over $1 per share. So when I throw those numbers out to you, and obviously that's not including, they've got a lot of firepower for buying stuff, buying back shares. We'll talk share buybacks and stuff in a little bit. But when I just throw those numbers out to you, how do you think about valuing that side of the company?
Well, I think it's fine as long as you value the net invested capital in the business as well. Because if you don't do that, what you're missing is that DE number doesn't include the appreciation of their $500+ million of invested capital that they have.
Yep.
Capital that they have in the
that's the asset side that we already talked about. Yep.
And then they have over $800 million of preferreds that pay between 7 and 7.5%. That is burdening that DE, and so I think that DE is wildly understated, and it will prove to be. If they hit their fundraising targets, then come 25, those numbers are going to be high. But setting that those numbers are going to be low. But setting that aside, I mean, what kind of multiple should it trade at? Blackstone's at 21 times. Blackstone has a longer history, but in the end, your multiple should be driven by the organic growth rate of the earnings stream. And I think that DigitalBridge is just going to have a much higher growth rate than you're going to see at Blackstone.
They're higher. And I guess the other thing I layer in is I think there's a little more leverage for DigitalBridge versus a Blackstone, both on the operational side, because we talked about that big slug of on the financial side, because we talked about that big slug of preferred that we're taking out of the DE side, not the invested capital side. And then on the second thing, they're smaller. The funds are startup, Brookfield. So you know how they talk about, hey, Brookfield and KKR both talk about, hey, your first and second funds, you actually don't really make any money off of. It's your third fund where you start. These guys are smaller. A lot of their funds are just starting. They've talked about in 2022, they were kind of doing the famous invest through the income statement thing where they were hiring people to go accelerate their fundraise, launch new funds. So I do think for both the financial and operational reasons, you get a little bit more leverage to the growth there. Obviously, you've got the digital tailwinds and everything we've talked about too, which, we can talk about if they deserve sole credit for picking them up, but I'll just pause there and let you talk about anything financial, operational leverage side that you wanted to chat about.
Well, I mean, to your point, let's say that they hit their 25 FEEUM fundraising goals, which is about double of today's FEEUM. Is the investment team going to be double in size? No. So, that will certainly drop. Or is the back office going to be double in size? No. So the margins are definitely going to get much nicer over time.
So let me just little pushback on, mentioned about a 20 times multiple on DE, which I don't have massive issues with, but I do just want to push back on two things. So there were two kind of deals on the asset management side for DigitalBridge in 2022. The first is Wafra owned a decent slug of the investment management side. They bought out the Wafra shares. I think that valued the fee related earnings stream at approaching 20 times earnings, which obviously the fee related earnings stream's a little bit higher than it's a little bit higher up in the income stream than the distributable earnings stream. And then the second deal they did was they bought AMP for a pretty low multiple on a run rate basis. AMP has now become InfraBridge. And I look at those two and I say, hey, are we turning around and slapping, call it a 20 times DE multiple on DigitalBridge's earnings stream when we've got two precedent transactions that maybe suggest the multiple should be a little bit lower?
Well, on the Wafra transaction, now they were innovative and securitized some of their fees during COVID to make sure that they had capital. Now they ended up not needing that capital, but when the world looks like it's going to end, that was a smart way to do it, and it was cheaper than issuing equity.
Yep.
And then on the purchase of Wafra, I mean, you should want them to pay as little as
no, I 100% agree, but it is, two sophisticated parties coming at a multiple. And it does strike me, it's the old, hey, if KKR agreed to sell a company to you for $2 billion, like, why do you think you're getting the good side of that deal?
AMP AMP had issues at the parent company. And I hear that their LPs were none too pleased with the parent company. And so they sold off more businesses than the now InfraBridge. It was what DigitalBridge brought, which is a mid-market infrastructure asset manager. The alternative to selling to DigitalBridge was selling to another mega PE fund who only wanted to buy the portfolio, and the team would have to have been laid off and dealt with and compensated to go away, etc. Ganzi recognized that he needed he could use a new offering in the middle market space. He could utilize the team, so he basically bought AMP at runoff mode. But what it gets them is, their margins were a little bit low, which DigitalBridge can get up, and so he gets some free juice there, and then he gets access to AMP's legacy LPs, so he gets to meet some new LPs there, and those LPs he can introduce to his other funds, and vice versa. His DigitalBridge's legacy LPs can now access a new product. And so he paid runoff mode for it. It was a distress sale. The alternative was to sell to a large PE fund that deals with distress sales and wanted only the fund and not the employees. He solved the problem, got a good deal. And if there's any revenue synergies from it, this is going to get real interesting for DigitalBridge.
Yep, that's perfect. And I think they've, as you were alluding to, they have said, hey, we're having good success. They had AMP had a bunch of logos they sold to on their side. We have a bunch of logos that we sell to on our side. We're having good success kind of commingling and cross-mingling. So I think we've covered, balance sheet value. You've got it at about $11 per share. Distributable earnings, take their 2025 number of about $1 per share. About 20 times multiple, that would get you to $20 per share. So basically both sides of that equation are about covering or more than covering the share price. People can do the math and get to a fair, pretty easy. That's addition, fair value there. But I do just want to ask one other thing. So obviously everything in investing is opportunity cost, right? And we could compare investing in DigitalBridge to investing in a micro cap in Asia, Apple, the largest company in the world, whatever. But I think the most direct opportunity cost here is going to be, hey, why choose DigitalBridge over another of the alts, right? And you mentioned Blackstone, which DigitalBridge certainly looks cheaper than Blackstone, but the three that popped to mind are one that I know you own, Brookfield, which has been doing a lot of spins to try to realize some value, much larger, a lot of balance sheet value there. PX, which is a popular kind of multi-strat fund, doesn't really have the balance sheet, but they've got a lot of growth and a lot of M&A potential. That trades at, if I remember correctly, I haven't updated my model in a couple months, about 11 times. So that trades very cheap. And then KKR, which has a big balance sheet. And I think that trades at like about 10 times 2025 distributable earnings, if I kind of look at what they've been doing and what they're projecting. So when I just toss that out and say opportunity cost versus alternative asset managers, why is DigitalBridge the play?
Well, because they have the secular tailwinds with the industry that they're exposed to. They have the tailwinds with allocators being under-allocated to this sector. Their fee-related earnings should be growing at a much faster rate than the competitors that you laid out. And if the market doesn't appreciate it, one would expect the KKRs, the Brookfields, the Blackstones of the world to come knocking on their door and using this as an add-on to their offering. So
that's perfect. Let me switch. So I think when I said, hey, we're coming on to do the DigitalBridge thing, got some pushback here. So I do just want to address some of the pushback. A lot of the pushback would address specific deals. I think Zayo was one. A direct quote on Twitter was, hey, if Zayo goes bankrupt, does that take a lot of the sheen off of DigitalBridge? And a couple others were, you've heard they closed Switch at peak multiples, or, a lot of the deals multiples kind of look high in retrospect versus the current interest rate and everything environment. And I think Marc's talked about that, but I just want to toss that over to you to either we can talk about specific companies or just the overall, when people look at these multiples, why they might be missing something.
I think that's fair. And, I was with the company in early January, and my message to them was like, listen, you have a narrative that, Zayo's in trouble and that you paid peak multiples for GD Towers and Switch. And so, you guys should change the narrative. And I think that they have done that with respect to Switch at Marc's presentation at the Pacific Telecommunication Council keynote address, which was a few weeks ago. The shorts are out there saying that Zayo was closed at 36 times. And the way they get there is they're using an LTM multiple at the time that the deal was announced, as opposed to using a forward multiple, which is what's done in valuations at the time of close, as well as that LTM EBITDA also had some kind of like one-time legal non-cash charges that made it artificially low. But if you kind of clean that up, and you can get to a 30 multiple, a 30 forward multiple. Then if you look at what they have signed, contracts that they had signed, and you throw that in there and take out the public company costs, you're getting down to low to mid 20s on Zayo. So that doesn't, that's starting to not look as egregious as kind of like the headline 36 times rest. But what was interesting about Zayo is that if you're going to grow a data center business, you need four things. You need demand, you need land, you need power, and you need permits. And that's what Zayo had in spades. And if you read the merger agreement with Zayo, which is all public because it was a public company, you can see that they raised $1 billion of equity in excess of what they needed for to close the deal. And they raised $1 billion equity of debt in excess of what they needed to close the deal. And that $1 billion could be pulled down 18 months from close. So what are they telling you they're going to do? Effectively, they're going to double the size of that business within short order. And at the Pacific Telecommunication Council keynote address, Ganzi goes through the economics of that it's about $70 million for a data hall at Zayo, and they'll get an 18%-ish unlevered return on invested capital from that. And so, if they're doubling the size of Zayo's business within a year or 18 months, at an 18% unlevered return, that I don't think anybody's going to be looking at those kind of headline multiples anymore.
That makes total sense. I think that's right. I do worry. I was going back through, and it seemed like at the investor day in 2021, they were saying, we've really transformed Zayo. We've really transformed the culture. We're really going to simplify the business and ultimately create value. And then, you go through 2022, and just on the Q4 call, they're talking about, hey, we think we've got Zayo turned around now. We feel good. Anyone who's in the bonds, we have strong conviction. You can sleep safely at night, which it all sounds positive, but to go from saying, hey, we've already transformed it in 2021 to, hey, the turnaround in 2022 took place and the signs are good. It sounds a little strange, right? It sounds like a little too Pollyannish.
They said to me that the turnaround took a year longer than they thought it would.
Yeah.
And it's hitting now. It's very EBITDA positive. It's not free cash flow positive, which means they're probably still investing into the business a bit. I think it'll be all right. What happens if it goes to zero? I mean, their reputation will be hurt a little bit with the LPs that they co-invested with, and it wasn't just them. There was another. I think EQT was their partner on the deal.
Yep.
And then it's probably 5%, 6% of DigitalBridge Partners One. So private equity funds have some bad deals all the time, and it's not, the size is not, it won't feel good, but it's not going to kill them.
Yep. Let me ask about just, I guess, the environment right now. So we've started talking, I guess we'll stick to kind of the multiples and acquisition environment, but I do want to talk about the fundraising environment because that's important as well. So just, DigitalBridge, it's digital infrastructure. Interest rates have gone up. A lot of the multiples have come down a little bit. How does that affect, excluding Zayo, just how does that affect their overall portfolio companies, tech companies laying off? And that's the defensive side and the valuation side. But on the offensive side, how does that affect kind of the outlook for them going and buying companies, lower valuations, companies that might be more willing to sell, all of that?
Well, let's just go piece by piece. I mean, interest rates go up, multiples come down, but multiples not the only way to create value. Earnings growth is equally important, or probably more important, because it also drives the multiple something gets. These funds that they have are long-lived. They don't have to sell today at current multiples. They have time to grow their earnings and to get yield from that, throughout the lives of the investments. Higher interest rates are certainly going to affect the companies that need financing, but they're 75% fixed, and their portfolio companies are under leveraged. So I don't think there's going to be any problems with having to deploy capital into, to shore up the balance sheets of their fund investments. I think that the hurdle rates are probably going to go up, for the investments that they're going after. I mean, if a core fund making 10, 11%, 9, 10, 11% rates was probably much more appealing a year ago than it is today. And so I think that the return thresholds are going to go up, but, the higher interest rates are going to, probably will create dislocation, sufficient dislocation where it's going to be very interesting if you have dry powder to deploy.
So that's on the multiples side for the business. I just want to talk fundraising, right? Go ahead.
Well, the fundraising side, I think that investors are so underallocated to it, but there's, what they're calling the denominator effect. So you've got the allocators have less capital to deploy. And so I think that's probably pulling back check sizes about 20 to 30%. So they're going to be out with DigitalBridge Partners 3. I expect that probably to come out at around $6 billion. The last one was just over $8 billion. Is it going to be a disaster that it was not as big as the last one? Given the interest rate environment and denominator effect, I think that'll be fine.
Perfect. So, and I believe they've talked about both at conferences and on the Q4 call. They said, hey, look, Q4, even after not disasters for them, disasters for the markets, Q4, they had really good results fundraising. I think they talked about they're having really good results early in 2023 fundraising as well. Obviously, that's important if they're going to grow that distributable earnings stream that we talked about earlier from, call it 40 to 50 cents per share this year to the $1 per share that we're talking about in 2025.
I think that we probably had a couple big catalysts this year, right? One of the big ones is simplifying the business, deconsolidating DataBank and Vantage SDC. There's multiple advantages in their portfolios. And then say having some substantial first closes on core credit and DB3 and articulating what the fund size are. That's going to be key for them, and articulate credible fund sizes, and hence like the sizable first closes. And if that happens, then this is going to get real interesting real quick.
Their 2025 targets assumes about $50 billion in fee earning assets, whatever their number is. I think they think in terms of scale, they could get to over $100 billion in assets. If you look at kind of a Blackstone or a KKR, 100 billion is a lot bigger than I'm running, but 100 billion isn't the largest in history in terms of the peers they're up against, but they're only digital infrastructure. So maybe there's some, how do you think about kind of the ultimate scale potential here?
Well, I forget which call it was, but one of the early calls, Ganzi walks through how much CapEx is deployed annually in digital infrastructure. And I mean, I don't know if it's quite $1 trillion, but it was maybe close to it. And so, having having decade plus funds and 100 billion of that doesn't seem like an egregious amount if you're deploying close to $1 trillion in CapEx annually.
Do you think they eventually branch out outside? I mean, they are DigitalBridge, but do you think they eventually branch outside of the digital?
I can see them doing some ancillary, investing in some ancillary industries, and probably through a PE fund, which would probably be their next one. I think they've had conversations with some teams that they like and would love to tack on. I mean, they kind of alluded to it on the last call, and hence kind of the M&A in the projections. While I think ultimately it would be great to have a PE fund in here too, kind of like what Brookfield did with Brookfield Business Partners, and invest in some ancillary businesses to digital infrastructure via that, and maybe ultimately at some point some software companies. I think that the low price of the low current stock price is a very high hurdle rate. So I would in the short run, I'd privilege doing some share repurchases over tacking on a PE.
And now, a quick word from our sponsor. Comprised of 40 of the world's leading digital infrastructure businesses, the BYTE ETF, ticker BYTE, trades on the NYSE and tracks the BYTE index. BYTE looks globally for companies such as mobile tower, fiber, and data center operators. For a prospectus and more information, please visit roundhillinvestments.com/ETF/BYTE. Read carefully. Investing involves risk, including possible loss of principal. Investors should consider the investment objectives, risks, charges, and expenses carefully before investing in BYTE. Distributor Foreside Fund Services, LLC. That's a great transition, because I think the last thing, there were a couple other things we could talk about, but I also want to be conscious of time. But the last thing I did want to talk about is, look, a lot of times when people talk about the alternative asset managers, they will say, hey, these are supposed to be the sharpest guys in the room. They're supposed to be great with financial allocation. And you think the stock's undervalued, but the sharpest guys in the room over there are not repurchasing their stock. So what does that tell you about where they see value? I think there's actually a lot of, as with everything, there's a lot of gray areas and complexities to that. But DigitalBridge did get decently aggressive with the buyback in Q4. So I just wanted to let you talk about the buyback and how you see that side of the capital allocation chart flowing over time.
I would see their appetite to do that is probably going to grow in the next few months. So if you think about, there may have been a situation where if they got real aggressive today or the last couple months on share repurchases, there may have been a situation where they had to pull down a revolver in order to affect some of the other commitments that they have. And so, for example, they've got some converts that expire in April. That's going to take a slug of cash. They've got they had $90 million of WAFRA earnout payment that's due on the 31st of March. They'll have some fund commitments, some GP commitments to their new funds, and so they have the closing of the AMP transaction, occurred in Q1. So they had some pretty significant outflows. Inflows, they've got coming in the continued monetizations of DataBank and Vantage, but the timing of that's questionable. So I think from them being conservative and not wanting to pull down debt in order to affect a buyback, they're kind of on hold until that got shook out a bit with respect to all the outflows going out and then taking in some of the monetizations that they've had in their funds, as well as DataBank and Vantage. So, the pressure is coming up on them. Now that they're going to have some more monetizations, like what are you going to do with that? So, I'm not really too sore that they didn't buy more shares back in Q4, but come Q2, Q3, if they haven't, then I'll be a little bit more sore about.
Look, I don't disagree with you, but I thought even Q4, given the constraints you listed, I think it was all, if you looked in the 10K, I'm doing this from memory, but I think all the buybacks really happened in October, but it was a decent bit of buybacks for a company with the constraints you're doing. So I actually talk a little bit of a different question. Last question, then I'll give you final thoughts and then we can wrap this up. We've talked Ganzi. A lot of people here, I do think, are Ganzi. When he took over in 2019, he famously, infamously, probably neither of the above, but a lot of investors do look at it. He got a contract that said, hey, you have to adjust for the stock reverse split, but adjust for that. If the stock price holds $40 per share for 90 days by July 2024, he'll get $100 million payout. And I know a lot of people look at Ganzi and say, this man is going to be incentivized to get to $40 per share. I think if you think about the sum of the parts we laid out, it doesn't take much to think another year of value creation, maybe a little bit of multiple expansions versus we talked about some financial engineering. Again, another year of value creation, maybe a really successful deal. I know a lot of people who look at that and say, this man is going to be really incentivized to drive the share price higher. I don't know. I kind of think once you get to call it a little over a year out and the stock's 75% below, 60% below, whatever it is, the target, I kind of think that goes out the window and the board will just re-up him another thing. But I do just want to talk about, because I know a lot of bulls talk about this payout level.
Yeah, well, it doesn't take too hard to kind of sketch out a valuation where that's possible. And,
100%.
And so I think, realistically, I think you're going to see, like, if the stock price starts to work with cleaning up the balance sheet, they're going to have, and once the balance sheet is and the financials are kind of cleaned up with DataBank and DigitalBridge and Vantage, you'll have another analyst day, and that might get some momentum going for it. But if it's not at $40 by September, you're going to start seeing sale rumors start to come out, I imagine. Whether they're true or not, it's just how the markets work, because everybody knows that they have to hit the 90 days is 90 consecutive trading days. So if you back that out, that's mid to late February 24. He needs to hit that $40 by. So
you do think that, look, if I had $100 million in line, it certainly incentivized me, but you do think that that payout, especially as you kind of clean up in Q1, Q2, as you get towards the end of the year, you think the company is going to have very high on their mind, hey, how do we realize that? Whether it's really aggressive on the repurchases, really trying to drive this home, or potentially exploring a sale, you do think that could be a catalyst?
I don't think that the sale's out of the picture. I would hope that it doesn't happen, because I want to own this for 20 years. I think it's exciting to find a compounder when the story is complicated and you get it cheap and you can own it for 20 years. And so that's what I would like to see happen. But I think just the market being the market and people knowing about this, and all the bulls talking about it, that, maybe you'll hear some rumors in September, whether or not that it drives him to do something extraordinary like a sale. I don't know. If the board does make a change to this, I would hope that two things happen: that if it gets extended, that the strike price goes up, so it's not 40 anymore. And I think that if the board extended it another 2 years and they made it 60 or something higher, then I think that's fair to shareholders. I think it would be looked at negatively by some shareholders if the $40 strike price stayed the same, and then he pushed it out a couple of years.
Yeah, that's the classic. I mean, it's tough because you've got to incentivize your top talent who's running literally billions of dollars to stay, but that's the classic heads I win, tails I don't lose, where, hey, we put a 5-year $40 target, you didn't hit it, so we just give you another 5-year $40 target. Shareholders languish, you still have a shot to make $100 million.
But he's got massive incentive with respect to the carried interest that he's set to realize if they raise capital and make good investments and harvest good returns, and so he's properly incentivized. It would be nice to see to your point that these are sharp guys and the best investors in their sector. Given how cheaply the common stock is trading, it seems like it's one of the best opportunities in the whole complex. It would be nice to see him and Ben Jenkins, the CIO, make some significant share repurchases, particularly since they realized some significant amounts of carry last year with the data bank recapitalization, and are probably set to realize some more, as they deconsolidate data bank and vanish SEC.
And if I remember correctly, they did buy some shares on the open market last year, but obviously you'd love to see, hey, we just got 30 million of carry, we set aside 10 for taxes, and we throw 10 of it into the stock at these levels because we're really convicted. Last thing, we've covered a lot. I actually had more I wanted to cover, but I've got to be conscious of time here. So I just want to ask, look, this is a story. I think we've done a nice job of simplifying it down, laying out the value, addressing some of the parts, but is there anything we didn't hit that you think investors should be thinking about, or anything we kind of glanced over that you wanted to hit a little harder?
No, I think we covered it pretty well. I mean, if they hit their fundraising goals, the earnings are going to increase at a massive CAGR, and there's going to be a lot of value there. In the meantime, you're buying it very close to runoff mode, so you have limited downside, and the upside can be pretty material, and the complications with respect to the financials are getting simpler. I mean, it's happening this year.
Perfect. That's a great place to wrap it up, Chadd. And again, Ave Maria Focus Fund, we can go look it up. There's some other interesting names in there. So Chadd, looking forward to having you on to talk about one of the other 16 holdings in your portfolio in the near future.
Yeah, we can do eDreams next or something.
eDream. I've done a lot of work over in the European travel sector. Well, we'll save that for next time. But Chadd Garcia, thanks so much for coming on, and we will chat soon.
Great.